we say, gee, you guys, your credibility was damaged. Now you've got to regain your credibility. Is that good for us and for the country that they have credibility, or are we paying for their mistake with a recession that we really, I don't feel like paying for their mistake with a recession just so they can regain credibility.
Well, first of all, you have no choice but to pay for their mistakes. And that's one of the tragedies of the situation. Yes, we're all going to pay for their mistakes. And some people are already paying.
Last week was cruel for traders and investors who were hoping that the financial markets would leave behind what has been painful triple warning this year, caused by tightening financial conditions. After a strong bounce in both stocks and bonds early in the week offered some hope, the markets yanked it back, essentially easing investors' gains as investment portfolios resumed their record-breaking downward trajectory. On the surface, investors would appear to have only themselves to blame for this whipsaw, given the sharp contrast between the romance yet again the idea of a Federal Reserve pivot and what for once has been consistent messaging for central officials, that no such policy change is in the offering. Below the surface, however, the situation gets more complicated, basically telling us the Fed is not coming to save you. This time around, we are really broke, guys. Broke! Let's continue. Perhaps investors do not need to hint of a Fed signal to front run what they think is a coming pivot. It is enough to search for the developments that would force such a pivot eventually if they come from overseas. After all, it is a strategy that reinforced the BTD, TINA, and the FOMO, conditioning that was previously incredibly in pushing asset prices ever higher. That is to buy the dip, as there is no alternative, especially given that the fear of missing out price rally. Guys, take this to heart. Do your research. Know the in and outs of what you buy. Go the opposite way of the crowd. Not financial advice. Let's continue. We are going to see how the Feds effed up, explained in detail by Mr. El-Erian. Moving forward, quote, I suspect that it was years of prior Fed conditionings together with insufficient appreciation of the underlying structural changes that made keen and inherently optimistic investors jump back into what turned out to be yet another ill-fated and this time very brief pivot romance. It is a reminder that conviction without sufficient foundation can often prove problematic as an investment approach. Editor, roll clips. Fair use.
Some economists fear that the Fed, humbled by staying too long and saying transitory, is now staying too long in terms of raising, and we don't know yet. We haven't had an earnings season. We don't know how it's really affecting things. They may break something. We may already be in a sharp slowdown. Maybe they stay at this party too long, the tightening party. You don't think so?
So there's two elements to this. Can they stop? Can they pivot? No, they cannot. They cannot because the data doesn't give them enough of a green light, but importantly, their credibility has been hit really hard. Will they end up overdoing it? Most likely, yes. So they've gotten themselves into this hole, and unfortunately, they don't know how to get out of this hole. There's no ladder out of this hole. People have to realize there's no ladder out of this hole. There was another concern that you brought up, Becky, this morning with Roger, which is it's not just about inflation, recession. It's also about financial stability. That's the third leg of this thing. So yes, Joe, I don't know how we can avoid paying for this mistake because they have been late. They mischaracterized inflation as transitory. When they finally recognized their mistake, they didn't act. Remember, in the middle of March, when we printed the February inflation print over 7%, they were still injecting liquidity into this economy. That's last March.
Mohammed, wait a second. When you say the third part of the equation, the financial stability, do you think there is the risk that things will be broken in the markets if they raise another 75 basis points?
This is the most front-loaded interest rate hiking cycle we've had for decades. We're coming from zero interest rates. The whole system got conditioned to believe that zero interest rates was forever, that injections of liquidity were predictable, and now we're adjusting. The UK has given us a warning sign.
But there are people in the market who still haven't taken the Fed seriously, so they have not gotten themselves to a place where they're not going to have massive issues if the Fed doesn't slow down?
So we have, first of all, this is the non-banks, not the banks. So that's the good news, because the banks are in the middle of the payments and settlement system. The non-banks are not. So that's good news. Yes, there are certain, you can start with the zombie companies who are finding it much harder to refinance. And if they can get refinancing, the cost of this refinancing makes their numbers look completely different. Mm-hmm. Then you can go to various investors who over-levered. that's going to be an issue. So yeah, we have to keep an eye on the third element, which is financial stability. It's not just about inflation and growth, it's also about financial stability.
That's almost an argument for slowing down and maybe only going 50 basis points, if that, at the next meeting, just because it's not going to help your credibility. If you're doing this for your credibility, things break and you have to instantaneously backtrack like the Bank of England did.
Mohamed El-Erian, he is the chief economic advisor at financial services company Allianz. He is also president of Queen's College in Cambridge. He's good enough to join us this morning from New York. So this week was a very volatile week in the U.S. stock markets. Volatility has been ever present, I would say, during this calendar year, but this week seemed really volatile. For our audience, break it down. What's going on? What is the source, if you can identify it, of that volatility?
So the main source of this volatility is changing perceptions of the Federal Reserve. We are in this incredible situation, Major, where good news for the economy is bad news for the markets. And that's because the markets are worried that the Federal Reserve will tip us into recession by overreacting to strong economic news.
Every White House I've ever covered, and it's been more than one or two, has said, you know, the markets isn't the economy. The economy is the economy. And what markets do, markets are going to do. Even so, volatility affects people's retirement, their planning, and their sense of their medium and long-term futures. How should people be looking at that? And when they hear the president, as he did on Friday, talk about navigating this transition, what does that mean?
So first, there's volatility and there's unsettling volatility. Volatility when things go up and down, and on the whole, you're better off over time. But that's not what we've had this year. We've had unsettling volatility because we've had the stock market down by anything from 20 to 30%. We've had bonds, which are supposed to safeguard your investment, also down by about 15%. So there's been nowhere to hide. That's why people feel insecure. That's why they look at their retirement plans with concern. The president is right. We are currently on what I think of as a bumpy journey to a better destination. And we need to navigate both the journey and get ready for the destination. There is a possibility that the Federal Reserve makes another mistake and that bumpy journey actually changes the destination. That's why the markets are on edge.
Is it your perspective that the Federal Reserve has already made a series of mistakes, either not acting fast enough or overreacting?
So it's made two big mistakes that I think are going to go down in the history books. One is mischaracterizing inflation as transitory. By that, they meant it is temporary, it's reversible, don't worry about it. That was mistake number one. And then mistake number two, when they finally recognized that inflation was persistent and high, they didn't act. They didn't act in a meaningful way. And as a result, we risk mistake number three, which is by not easing their foot off the accelerator last year, they are slamming on the brakes this year, which will tip us into recession. So yes, unfortunately, this will go down as a big policy error by the Federal Reserve.
Continuing your metaphor, slamming on the brakes, does that mean it is impossible to achieve the either literal or mythical soft landing?
Even Chair Powell has gone from looking for a soft landing to a softish landing to now talking about pain. And that is the problem. That is the cost of a Federal Reserve being late. Not only does it have to overcome inflation, but it has to restore its credibility. So yes, I fear that we risk a very high probability of a damaging recession that was totally avoidable, Major.
One last thing before I let you go. We have about 30 seconds. About 2 or 3 months ago, it was common for people on the web to see stagflation headlines. We are not in a stagflation situation.
We are. Growth is coming down. Inflation is still high. Unfortunately, it's not time to eliminate that term yet.
Very good. Mohamed El-Erian, we thank you so much for your time, and we will be right back.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to this unsustainable economy. It's just crazy how these banks still think that zero interest rates would stay there forever. But since the feds erased the work and earn, save, and build way of life of Americans used to abide by, now they feel entitled and think that Papa government will always come to the rescue. So as we have seen, it's not what's currently happening. So guys, stay getting prepared and move accordingly. Thank you for the support. I'll continue to bring you my best so we can continue to grow. Stay free.
It ain't hard to tell. I excel, then prevail.